Hey there everyone, Dave Keller here with Market Misbehavior. Hope you're all doing well, and today we're going to talk about the S&P 500. Not what it's done, not necessarily what's happened recently, but more about where it may be headed. This is an exercise in what we call probabilistic analysis, and this is the latest episode in our Choose Your Own Adventure style videos where we think about different potential future paths and their implications. Here's what I found, having spent many years working with big institutional money managers and strategists, and also working with individual investors, advisors, kind of everyone in between. Individual investors tend to think more binary outcomes or really get caught up in narratives. We get caught up in confirmation bias sort of situations where we think about what we imagine is going to happen, and then we kind of put the blinders on and we forget to recognize that that's just one potential scenario out of many that are possible. What I found working with institutional investors tend to be a little more open to different scenarios. You think not in terms of absolutes, but in terms of probabilities. You realize that there are a lot of different things that could happen to a particular stock or ETF or index, as we'll talk about today, and any of them are possible. We want to think about what's more probable, what's less probable, but recognize the fact that all of these different scenarios are possibilities. What we don't want to do is get surprised by what happens tomorrow. We want to have a good game plan. If the market has a super bullish scenario and reaches 7,000 by the end of November, or a super bearish scenario, where we're talking about the 200-day moving average and some of the different scenarios that could happen between those two extreme potential outcomes. So today we're going to talk about the S&P 500, 4 different future paths. Before we get there, we're actually going to talk about the last time we did this video back in July and which scenario played out almost perfectly with the actual behavior of the S&P 500. Before we get to those charts and implications, here's one more thing I wanted to tell you about. I spent many years earlier in my career working for large financial institutions, and when I left the institutional world, I remember thinking, what am I going to do to replace these big, expensive, but powerful institutional investing platforms that I've had access to this whole time? There is an option now for individual investors and financial advisors, and it's called Koifin. Koifin really combines some of those great capabilities of the big, expensive institutional platforms, along with some capabilities really optimized for financial advisors and high net worth individuals, and puts it in a very low cost, underpriced package on a web-based platform compared to the possibilities that you can achieve by using said platform. One of the features I love to use on Koifin are the ETF holdings. You can take an ETF, you can, like the QQQ, you can look at the biggest weightings, you can look at weightings by sector, you can run some basic attribution analysis. So for ETFs that you own or that you're considering owning, doing the due diligence of really understanding the exposures you're going to get is super important and super powerful for your portfolio. If you go to marketmisbehavior.com/Koifin, you can get 10% off any new membership. I hope you will check it out, and I hope you will find it as meaningful and powerful and impactful as I have found myself. Now let's get back to the charts. All right, so the last time we did a Choose Your Own Adventure style video for the S&P 500 was on July 8th. Now we've updated this chart obviously from July. This is when we did the video right after the 4th of July holiday here in the US. We outlined 4 different scenarios. So the super bullish scenario, where the S&P would get up to around 6750 by the end of August. The mildly bullish scenario, with the S&P more around 6350. A mildly bearish scenario, where the S&P would basically test the 200-day moving average, which we expected to be around 6,000, 6,050. And then a super bearish scenario, where the S&P would actually make a 38.2% retracement of the April to July run, putting the S&P around 5750. If in that last video you selected option 2, the mildly bullish scenario, congratulations, you were spot on. And I'm so fascinated, having done these videos pretty regularly over the last couple years. Look how beautifully, almost perfectly identified that price point. So what happened, right? Well, to be honest with you, what happened in the actual markets after an acceleration off of the April lows, a continuation from the price gap in May and June, late June, we had that rally, July into early August, sort of had the slope that we had back here in May and June. It wasn't like an exponential rise like we saw at the end of June or in late April. It was more of like a slow and steady kind of lower volatility grind higher. And as a result, the S&P gained sort of a decent amount, right? The slope kind of slowed down. and we ended up right around 63.50 third week in August. The super bullish scenario was basically assuming that accelerated uptrend would continue, and that we'd have this ultra euphoric rise up to around 67.50. It's not lost on me that literally today, this week in early October, we did eventually make it to the end of arrow number one. It just took about another 6 or 7 weeks beyond the time frame that we laid out, which is usually about a 6 to 8 week, forward-looking scenario is what we're generally keeping in mind here. You all can also notice, what part of this exercise is to sort of estimate where moving averages are going to be. So we had kind of an estimate of where the 200-day moving average may be. As you can see, 200-day was actually a little bit lower, but neither of those were really in play, right? The S&P remained above its 50-day moving average where it sits today. It's also above its 21-day exponential moving average and even shorter-term trend following mechanism. So congrats. If you selected option number 2 last time we did this, you picked it. You had it right on. Again, the goal of this is not necessarily to be right, although that always feels good. The goal of this is to force ourselves out of our comfort zone. So you're going to find that one of these scenarios sounds like the most likely scenario, and that's great. That's probably how you should be positioned in your portfolio today for that potential outcome. But don't forget that each of these 4 scenarios I'm about to unveil are possible, right? From a super bullish scenario to a super bearish scenario. So think about how these different scenarios could look and feel, what market conditions could occur to, basically compel those scenarios in the markets themselves. And then you won't be surprised when one of these actually plays out, just like scenario 2 did last time. All right, here's the current chart of the S&P. We've updated a little bit, add some new lines, so it's a little busy, so let me talk you through what we're seeing here and what the exercise is. So the S&P 500, of course, over the last 3 months has just been in a fantastically straightforward uptrend. The volatility remains very, very low. The market remains in a fairly risk-on position. The S&P is making fresh new all-time highs here at the beginning of October. So we ended third quarter in a position of strength. We continue in the fourth quarter so far with that strength continuing. So I've drawn a bit of an uptrend channel using the highs from July, August, September, and the lows. I've basically made a parallel channel, and you can see that the highs in July and the lows in August make it an almost perfect parallel channel. So just extended those parallel lines, basically saying this is the pace of the market right here, right? This is how the S&P has advanced over the last 3 months. So if that advance continues, but we get toward the upper end of the channel, because I would say this is a pretty strong uptrend. There may be a possibility that the uptrend accelerates. I just see that as highly unlikely. So the most bullish I'm comfortable being at this point, super bullish scenario for me would mean we reach 7,000 basically by Thanksgiving. We're right around that 7,000 level. And if we continue with this pace and get more toward the upper end of the trend channel we've experienced over the last 3 months, that would pretty much be where we're at. So what would need to happen for that scenario number 1 to play out? To be honest with you, more of the same. The VIX, the volatility would need to remain fairly low because we want to be in a sort of steady uptrend state. Credit spreads, right? Those other risk measures that would imply investors are getting nervous would have to remain in fairly bullish configurations. The S&P would just need to keep grinding higher highs, higher lows. We'd have to have no negative shock from the Fed, none of the government shutdown, geopolitical issues. None of that would have to be significant enough to change this uptrend that we've experienced so far. It's not hard to imagine that's happening because that's been happening for the last 3 months. So basically October and November look a lot like August and September, and that's pretty much where we would end up around S&P 7,000. Now, what if this uptrend continues, but the pace is not quite as strong, right? What if we end up more at the lower end of this uptrend channel? So the uptrend is still in place, but just the slope of the trend slows down, right? Scenario 1 basically means what we've seen in the last 2 weeks kind of continues. Scenario 2 is a much gentler slope. That would mean basically the market, slows down a bit. Maybe the breadth conditions remain a little, have deteriorated. They remain in a negative divergence. So we're seeing the market going higher, but on weaker breadth, maybe weaker momentum. And as a result, just the pace of the advance slows. Maybe leading names like Broadcom, Amazon, Meta, these are all big mega cap growth stocks that are kind of pulling back and testing support. Maybe they are, remain in a position of short-term weakness And as a result, we have mixed results. We have things like semiconductors still doing well, but we have other growth stocks starting to struggle, and that kind of divergence really, just slows the pace a little bit. And the market's still going up, but just not going up as fast. That would basically put us at the lower end of the trend channel, probably put the S&P around 6,800 or so toward the end of November. All right. This gets us to the mildly bearish scenarios. It's not hard to imagine what would cause some bearish scenarios to play out because we've been worrying about them and debating them for months, right? This market, by any stretch, is overextended, overvalued, right? Growth stocks have advanced significantly, and while earnings have still been okay for sure, we are valuing these companies at extremely high levels, right, relative to their actual earnings at this particular moment. The AI-fueled optimism, let's say that starts to dissipate. Those leading AI plays start to pull back, and if some of those big, growthy AI names start to come back, it's not hard to imagine that other stocks would start to sell off as investors recognize there's a bit of a deterioration happening. That weakening, that's scenario number 3, and we'll talk about the particular levels in a minute, but I would say that also would mean that we start to get warning signs from some of those classic risk measures that we like to follow. Volatility starts to increase, right? The VIX starts to go higher. Spreads start to widen, credit spreads, meaning bond investors are starting to get nervous. We start to see more risk-off scenarios. Maybe defensive sectors like consumer staples start to perform a little bit better. That's scenario number 3, in my opinion. What differentiates this one is we break below the 50-day moving average. 50-day moving average currently is just above 6,500. We kind of continue at a similar pace. That means it gets around 6,600 or so a couple weeks out. I think scenario number 3 breaks the 50-day. Any of these bearish scenarios, I would say the S&P is below its 50-day moving average by Thanksgiving 2025, which is basically last week in November. So scenario number 3 basically puts us around 6,500, 6,550, which isn't too far. It's about 200 points below current levels on the S&P. That's a pullback, but it's more of a time correction than a real steep price correction. All right, this takes us to scenario number 4. You always need to have a doomsday scenario. We are happy to provide one as always. Well, let's say the S&P breaks below the 50-day moving average. The uptrend is nowhere in place. Breadth has deteriorated. Now price starts to deteriorate as well. Defensive sectors start to do much better. Maybe we start to get confirmation or implication from Fed governors and from Fed Chair Powell that the pace of declines or pace of rate cuts starts to slow down. Maybe the job market starts to concern. Maybe inflation data comes in a lot hotter than expected. There's a lot of macro data, assuming we start to get macroeconomic data again at some point when the government reopens. But let's assume some of that data is less optimal and less supportive of this risk-on scenario we've been in. Not hard to imagine that stocks would start to sell off. And with any of these sorts of things, the moment you start to see stocks sell off, that's when you can have a waterfall decline as more and more investors sell off. And the more we pull off, or the more we pull back, the more investors get nervous. That fuels further selling, and it's sort of a negative feedback loop as the market goes lower. I would say the very bearish scenario in this point, in my opinion, kind of puts us down around the 200-day moving average. That's estimated to be around 6,200 toward the latter half of November. And so that's kind of what I would see a doomsday scenario look like. Look, is there a possibility we just go straight down and go to 5,500? That's theoretically possible. I would bucket that as highly unlikely. I would say a much more reasonable expectation for a bearish rotation would be the market goes down quite a bit. 6,200 would be about, 500, 550 points below the current levels on the S&P. That's a big number. That's an 8% decline on the S&P. That's not a small number, but it's still within the range of a reasonable corrective move within a cyclical bull market phase. And given the run that we've had, I think that's probably the most negative I would see things happening, barring some huge scenario I haven't thought through just yet. So those are your 4 options. Those are the 4 potential scenarios that I see playing out between now and the last week in November. Please think about these 4 scenarios. Think of which one you see as most likely and why. Drop a comment below this YouTube video. Tell me which scenario you see as the most likely and explain your justification. After you've watched the video, after you voted, take some time and read some of the other comments. That's one of my favorite parts of this exercise, is you get to see what other investors are thinking. Because the whole point of this, again, is not to be right. The point of this is to make sure we've thought about different potential scenarios. Think about what you and your portfolio would do. In scenario number one, are there any bets you would want to make sure you follow that trend as long as possible? What if scenario 4 plays out? At what point would you see the chart of the S&P deteriorate? What would be your signal, your line in the sand where you would start to get defensive in your own positioning? Think through that sort of thing now before the market actually sells off. Think about your game plan today. So once again, here are the 4 scenarios. Scenario number 1, the super bullish scenario. The S&P continues, goes to the upper end of that trend channel, ends up around 7,000 toward the end of November. Scenario 2, the mildly bullish scenario. The S&P gets to the lower end of the trend channel we've been in the last couple weeks. That puts us around 6,800, we'll say, toward the end of November. Holding the 50-day moving average, I think, is an important distinction. Scenario 3, the mildly bearish scenario, we undercut the 50-day. Maybe we end around 6,500 or so toward the end of November, but we've had enough of a pullback that investors are really starting to question the sustainability of this uptrend. The very bearish scenario, scenario number 4, that puts the S&P around the 200-day moving average, probably around 6,200 toward the end of November. At that point, it's hard to deny we have had a major correction. Now the question is, does the S&P find support at its 200-day, setting us up for a strong December or not? Don't forget to vote which of those scenarios you see as most likely and why. And thank you so much for watching today's video. By the way, if you're looking for my daily market recap show, you're in the right place. We broadcast live here on YouTube, also on Facebook, LinkedIn, and X every weekday after the close at 5 p.m. Eastern, 2 p.m. Pacific. So make sure you follow me as we recap the daily market activity and highlight some charts of interest every trading day. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, and remember, it's always a good time to own good charts.